Hi, my name is Jason Swartz and I'm a portfolio manager at Old Mutual Investment Group. From a domestic institutional investor perspective, I think the overall budget delivered quite a wide spectrum of both positive and negative aspects compared to the momentum of quite strong fiscal performance seen in the prior years. The positives for us were a renewed commitment to deficit reduction, and that is clear and unchanged. We also like the clarity regarding debt relief for Eskom and the long-term benefit to SA growth from Eskom being able to unbundle. And I think the tax benefits for both consumers as well as corporates and incentives for them to be able to institute renewable energy was positive. I think from the negative side, and something that was well commentated on, is the downward revision to fiscal targets due to both combinations of lower South African GDP growth as well as the uncertainty around Eskom's capacity, also the limited upside in terms of the tax revenue overrun, and lastly just Eskom's debt being able to add it into the fiscal path. What does it mean for us as asset allocators? I'd like to touch on 3 quick points in terms of the key asset classes that we look at and how it was impacted on the budget. For nominal bonds, clearly there are some key drivers for local bonds, global bond yields as well as global inflation outlook, but also local inflation and the monetary policy we have in South Africa. As it pertains to the budget, issuance is very important from a supply perspective. So we like the fact that National Treasury undershot its deficit forecast, but in terms of Eskom's transfers and the significance of that, we think that there's a high risk for increased issuance in terms of their borrowing requirement. They may take the route of hard currency debt as it's a relatively cheap form of funding, and it also remains well within their foreign debt risk benchmarks, as well as the fact that we've seen renewed investor appetite improving for hard currency emerging market debt. Just quickly on SA equities, we think the big debate here is how SA equities will be impacted by lower GDP growth as it pertains to load shedding, and to what extent this impacts earnings growth. For us, we've taken quite a hard look at the numbers, and outside of a few selected consumer-facing sectors, such as retailers, property, and potentially banks, we don't think that there will be significant drag on expenses, as this index as a whole is fairly resilient, and many of the earnings drivers are from global drivers such as commodities in China. So we're fairly confident that in a worst-case scenario, you could get high single-digit earnings growth, and this would be positive real growth. And on a valuation of 10 times PE, we think that this is an attractive investment. So from a budget perspective, we think on SA equities, we're fairly neutral there. Lastly, on the Rand, I think the Rand is facing quite a big dilemma because it's been quite a significant underperformer this year due to the strong dollar, which has strengthened on some hot US macro data in January, but also against some of its emerging market peers because of news flow around load shedding, nervousness around the budget, as well as grey listing. And I think the dilemma is because this suggests that there should be limited downside risk, but a lot of the positive drivers for the Rand in the short term are quite difficult to be optimistic about, given some of the fading momentum in fiscal performance. I think potentially the 2 positive drivers or tailwinds in the medium term could be the global disinflation trend and the dollar restarting its structural weakening bias. And the other is just positioning, which has been really poor. So if you look at derivative contracts that have been short, we've also seen exporters holding back on converting their dollars, while importers have been fairly consistent in selling rands. And some of that unwinding of exports would see some support in the Rand being stronger. I think also from a positioning perspective, equities and bonds domestically are under-owned, and with sufficient valuation support, you could see market participants coming in back into our currency as global risk appetite improves. So in conclusion, and how we take this through to our portfolio positioning, is that despite some risk to issuance for SA bonds, we think yields of 10.5 or 11% are really attractive in this environment. And we think SA earnings can be fairly resilient given the news from the budget. And overall, from an SA allocation perspective, we like SA assets, and we think that the recovery in the Rand should support an allocation to be overweight South Africa.